Hi there, I'm going to be going over a fund buying strategy that I've backtested in 1988 and it would have returned you over 1,000%. So if you'd invested, say, £1,000 into this fund every time certain criteria is met, which I'll go through, then you would put down £18,000 over since 1988 and it would have returned you over £200,000. Now, because this fund tracks the biggest 100 companies in the biggest economy in the world, it's relatively safe. And I say, past performance is no guarantee of future returns, but I feel this strategy would do well nonetheless because it's buying, one of the best performing funds at the right price. Okay, so even if you just bought it, accumulated sort of randomly over the last, just held it on the last few years, you've done well. In the last 10 years, this index has returned 480%, and since it launched in 1971, its returned, well, it started at 100 points, that's what it started at, and now it's at over 8,000 points. So you can see the return is there anyway, but it's not about, what you buy with stocks and shares, it's also about how you buy it, and that's why I put a strategy into buying this fund. So first of all, I want to talk about funds. What is a fund? If you don't know, a fund pools money together from different investors and the manager invests on your behalf. Funds can invest in various types of assets, for commodities, bonds, properties, depending on the investment objective of the fund. So first of all, why invest in a fund? It's easy, it's efficient, and a convenient way to invest. So why is it efficient? As opposed to investing in individual companies, a fund, at the press of one button, one investment, you're instantly diversified across, say, 50, 30, 100, depends on how many stocks in the fund or commodities, but across several different shares. So let's say, for example, you're buying a dividend-paying fund where the fund just focuses on companies that pay dividends. It would basically, the one I'm looking at the moment, the one I own, has 50 companies in it. So one share purchase and instantly you're diversified across 50 companies, so that's easy. And so what type of funds exist? Anything, pretty much. There are many types of funds. So you can look at certain geographies. Like you can invest in the UK, in Europe, in the US, the Far East, or all of them. You can look at established companies in the Far East. You can look at the growing companies in emerging markets. Anything at all. You can look at commodities like gold or silver, IT, automation, robotics. There's all different kinds of themes and funds. Okay, so why or who should invest in funds? Now, first and foremost, I started investing in funds, and I think any new investor should start with a fund. It's very easy. All the work's done for you. Like I said, the fund manager does all the research to have certain criteria. You don't have to go searching for stocks elsewhere. You do your own research and all that, even when there's lots of jargon and all that stuff to figure out. So for a new investor, it's ideal. A fund is an ideal way to start. I mean, I would look at a total earnings ratio on a fund. That's one thing to look for. I'll get in that in a bit. But I also say funds are for experienced investors as well. A core to your portfolio. It's very good to have a core. For example, if I have, say, 30% of my portfolio in a fund and the rest I do active investing, then I know I have a certain consistency and diversification to 30% of my stock. So if the rest go wrong, then at least I have some kind of, some consistency there. So if I'm investing in dividends, I get paid that dividend all the time. I wouldn't have to go searching. Like, I like small caps. I like researching small caps, and I don't particularly enjoy, well, I don't mind it, but it's not a passion of mine. I don't particularly enjoy researching big caps and looking at the dividend cover they have and whether they can afford paying a dividend. So I just invest into a dividend-paying fund because that's done for me, So it's not a headache. So I think it's good for all kinds of investor, new especially, but I also think for experience, so for everyone. Okay, what to look for? Now, there's loads of providers of funds. It's like looking for a mortgage, essentially. There's so many out there, unbelievable. So whatever one you go for, look at the cost of a fund, because the more it costs, the more it'll impact on your returns. So it's something called the total expense ratio, okay? Now, all you need to know is this. I never look for anything that'll go above 0.5%, so 0.5%. I never look at that. Tracker funds, that basically track an index, that's all they do, should be very cheap. It should be like down by 0.1, 0.2%. That's how much, because there's no active managing going on. So there's no cost there, you know. If it's actively managed in some way, like I said, dividend paying companies that are filtered and that have to be changed and rebalanced every now and again, and this research is taken, then that'll be a bit more expensive, like 0.5%, something like that. But try not to go above that because it impacts your return, okay? By the way, I will put a list of funds I hold below in the description box below on YouTube here. And also, personally, you'll see that they're only from BlackRock and Vanguard. That's all I look at because there's so many providers, and it's pretty much like for like. You know, BlackRock is the biggest investment company in the world, and Vanguard are very low cost and very trustworthy setup, and I just like their ethos. So that's about funds. So the strategy I'm talking about, okay, is buying the NASDAQ 100. Now, NASDAQ, it's non-financial, by the way. NASDAQ is obviously a tech sort of focused index in the US, and it's pretty much the biggest and best companies in the world. So you've got Apple, you've got Microsoft, and it's funny actually, if you go back to 10 years, some of the biggest companies were oil and gas companies. Now they're tech, and I think this will continue. So there's some of the best performing companies in the world, and the top 100, like I said, all the big companies in there. So this is an investment into a fund into the biggest companies or the best performing companies on the biggest economy in the world, in the US. All right. So if this fund goes wrong, then everything will go wrong. You know, if the US implodes, the strongest economy in the world, the dollar implodes, which so much is based on, then the financial system will crash. So it's safe in that respect. You know, we're all going to hell in a handcart if that economy goes through. So first and foremost, it's an excellent performing fund, and I'll show you the performance right now. So let's go to the iShares website. So click on products. Okay. Up you'll get, this is BlackRock shares, BlackRock iShares ETFs, by the way. Exchange traded fund, they're called. So these funds are traded like a share, so you can buy and sell like a share. So you have all the categories here. So select category, ETFs, there's 387 here. I'm not going to do that. I'm just going to click on performance. So I've got all of them there. And you can see here, discrete, annualized, cumulative, so that's year and year. So let's click on annualized. List view you need over here. And click on inception. And there we go. And right, 5 years. There we are. 5 years and 14%. 3 years over 3 years at 90%. So this is return. So Palladium is the best performer here. NASDAQ is the second. Now, I'd ignore Palladium. So let's go for Palladium because that's just a play on one commodity. And as you know, commodities have cycles. They go up and down. At the moment, Palladium's in a hot space. You know, the EV market and all that stuff. And so it's seen as very, you know, a hot commodity. So I'd ignore that. Now, NASDAQ 100, if you click on that, it will go into some information. Now, at the top of the screen here, you see a fact sheet, but it does have information here. So year to date, it's done, the NAV, net asset value, but NAV total returns, 12.5%. So targeted and exposed, largest non-financial stocks listed on the NASDAQ stock market, direct investment into companies. So this fund invests directly into these companies. Scroll down, they'll have capital risk here, performance here. You can see a chart. Like I said, it's a good fund, but right now, it's not the time to invest in it because look, we're up in the middle of, you know, a sort of run here. We're not at the top, we're not at the bottom, we're in the middle. That's dangerous territory, really. It's, you know, when it comes down to it, buy low, sell high, you know. So you want it to come down here. So what's the theory here? So let's just go through first of all. Let's look at the key facts. So the key facts here. Total expense ratio is, where is that? There we are, 0.33%. So it's below 0.5, like I said. There's the net assets of the fund. What is that, 2 billion, is it? Or is it more than that? Yeah, 2.7 billion. And they have the portfolio, and they'll go across all different areas here, registered countries. They'll have the top 10 stocks: Microsoft, Apple, Amazon, Facebook, Alphabet, Intel, Cisco, Comcast, PepsiCo. So big companies, that's the top 10. They always have that. If you want more information, just click on the fact sheet up here, okay? Now, this is how I've decided to buy this company, all right? So I've looked at the chart. This is the NASDAQ chart. And I've scrolled back to 1988. Let's see, scroll all the way back to 1988. All right. Where are we? 1998, 10 years back. And I've done all this all the way back to 1988 just because I think it's, it's 20 years, isn't it? So that's why I've done that. And right at the bottom, let me bring this up. Right at the bottom here, you've got the relative strength index. This is the strength. It's based on momentum of a stock, okay? And on a 14-day time frame. Now, I've decided, and I've played around with different kind of RSIs and different levels, but when it basically, when this goes above 70, it's regarded as overbought. Doesn't mean it'll sell off straight away, but it means there's a higher probability that the share price will come back, all right, because it's been overbought. Below 30 means oversold. And again, doesn't mean the share price will bounce back up straight away, but there's a good chance it will be happening. The probability will go up. It's going to happen. So I've looked at this as 30, and I put this down to 23. I've decided, now I've messed around with this, as you can see from my spreadsheet here. This is on 26, I think this one was. This is on 23. But I've decided to buy this fund every time the RSI hits 23. So that's 86. So we start off here, 23rd November 88, and every time it dips, as you can see, all the big dips in this share price, all the big dips in this share price, and it touches 23. Even there, you can't even see there, and there. This is what's that? That's a .com boom. Look at that, nuts. 5,000 odd back down to 1,600. So you wouldn't have bought up the tops here. You would avoid buying the tops. You'd only buy the bottom. So avoiding the peaks, buying in the troughs. Another one here. This is 2009 financial crash, of course. 2008. There's another one here in 2011. There's another one here 2016. You would have bought last October actually on the back sell-off. Anyway, let's look. Like I said, this is one where I did 26 RSI. You had to buy 32 times then and returned that amount. It'd be 586% if you'd done that. So not as good as this one. Look at this one. If you'd bought every time it hit 23, these are the dates, these are the levels. All right, that's the average buy price. The average buy price would be here. Increases through these decades. Look at that. In 2001, 2008, only twice it touched that RSI of 23. So if you put $1,000 in, these are how many shares you'd have been buying. Okay, that's the amount of shares you'd get. Times that by the current share price is actually more than that now. That's the amount you spent. That's the amount you get back. That's return 1,048. Like I said, past performance is no guarantee of future performance, but this fund has done very well. Has returned what close to 500% in the last 10 years anyway, and that's if you can just buy and held. If you've been buying on dips, you've done a lot better, and that's why I come up with this theory. So what I'm going to do is I'm going to be buying this fund every time it does this. It's a long-term plan. This is like a retirement plan. Okay, so I know it's not a get-rich-quick scheme, but I'll be buying every time the RSI hits 23. And I'll do a video update on it. So if you subscribe to the channel here, you get that video update. But like I said, first and foremost, 3 things you have to do. I say 3, that's off the top of my head. Number 1, set up a stocks and shares ISA account if you're in the UK. ISA account, okay? That is tax-free. You can put 20 grand a year into that, and it doesn't matter how much money you make on that 20 grand, it's tax-free. So every year, financially, you can put 20 grand in. And anything you earn off that in the shares you invest in is tax-free. Secondly, do a quick search on funds, and do your own research on them. And you can buy funds in ISA. Certain stocks you can't. Not many of these actually. But you can buy in ISA. And thirdly, subscribe to the video, and I'll tell you when I'll be buying. Of course, this is based on the biggest companies in the biggest economy in the world. So it's the kind of thing you can, when there's blood on the streets, you can just buy. And people are selling like heck. When you see the news saying, the stock market here today was $17 billion was wiped off the stock market in 3 hours of trading. That's when you're buying. Because you know what? It's not like buying one company when a company's share price dips. If one company's share price dips, there could be something wrong with the company. It could be a balance sheet mess up. It could be profits warning. The company could be going through, could have too much debt. When you're buying a fund, you're buying 100 companies, so you're well diversified. So there's a good chance, an excellent chance actually, that will bounce back. The biggest companies in the world. So that's why I like it. And it's the kind of thing I think any investor, a fund should have in their portfolio. Hope this helped. If it does, please like, share, any comments at all. And by all means, subscribe.